That's fine. At least that's fine because I can download from Facebook and it'll be fine. I will make you the host. Okay. Okay, go ahead. Okay. And thanks everyone for joining us. If you have any questions as we go through today's presentations, feel free to put your questions in the comment section. At the end of the presentation, I'll be able to look. While Paul is sharing his slides, I may not be able to see, we're not able to see the Facebook screen. So thank you for understanding that.
No problem. So, can everybody see the first slide there? Just the introductory.
I can see it, Paul.
Everybody's good?
Everyone should be able to see them as well. Thank you.
So really segregated funds in general are talking about preserving your wealth as well as making things simpler for not just yourself, but for your beneficiaries, as well as possibly your parents as you transition from one stage of life to the next. So I'm going to go through a little bit about mutual funds and segregated funds, and then talk a little bit about sort of the benefits of segregated funds, finishing off with talking a little bit about the estate value of them as well. So first I have to put up a company policy. Always there's a disclaimer talking about segregated funds. I'll leave that up there for a second so everybody has a chance to read it.
Yeah, and one last thing I wanted to say, Paul, the reason you're even joining us today is because Canada Life, the company that you're with, happens to be one of Canada's largest providers of segregated funds. So you have the markets, you have a good share of the market, and so you're obviously in a good position to share with us about this topic.
Oh yeah, Canada Life has been around since 1876, so 140 years. So it's we're not going anywhere. We've obviously been through a couple of world wars, depressions, now COVID-19. So we're as we progress, Canada Life has always met its obligations. So that's something that you can count on when dealing with a large firm like ourselves. And when it comes to money management, so like segregated funds, between our pension money and our individual client money, we have about $1.3 trillion in assets under management. So
wow.
Very, very, very large company. Comparable to the banks, we're either better or the same as the banks when it comes to credit ratings. So S&P and Fitch and so forth that rate the different financial companies for their financial strength. We are always up there, either level or greater than the 5 major banks in Canada as well. So a very, very strong company, been around for a long time.
And I have to say, I love Canada Life on the insurance side. You certainly have very strong products on the insurance side. I'm talking about the life insurance policies, your whole life products, very strong. You're very competitive on term policies, on your critical illness policies. So I love working with Canada Life. Your e-app is getting better. I recently had the experience of submitting a Canada Life electronic application, and there is a bit of electronic paperwork that I had to finalize, but anyway, I now know what the process is, and it will be better moving forward.
Yeah, we're these days things are accelerated quite a bit. So what was not possible a few months ago is now possible, especially when it comes to digital and electronic applications and e-signatures and things like that. A lot of that is now possible, like I said, whereas beginning of the year it was not.
I'm very happy about that because
yes, makes things easier for you as the advisor and you as the clients as well.
Absolutely. And yeah, I have to say, like in the past, having to deal with the investment side of the business, there were multiple paperwork requirements, compliance requirements. And the fact that now all of that can be done digitally is a huge relief for me. And it is just easier because sometimes if you're filling out a large paper application, if you miss one thing, then you have to go back to the client for an additional authorization. Now all of that, all those checks are done digitally. My life is so much easier now, and I'm very grateful for that. So,
yeah, it definitely makes things easier. So here's a quick agenda of what we're going to be talking about. I'm going to cover the segregated funds and sort of do a quick recap on mutual funds as well, so everybody understands where we're coming from and being able to do a apples to apples comparison between the two. I'm going to talk about the segregated fund benefits, talk about segregated funds as an estate planning tool. And then no conversation is complete without talking about the cost of investing. And we'll sort of get that into at the end of the presentation today. So mutual funds and segregated funds There's a lot of similarities between the way these are operated, but it's important to understand that they're actually two separate types of governing bodies that these are operated under. So mutual funds is operated under the MFDA, the Mutual Fund Dealers Association, and the insurance segregated funds is operated under the Insurance Act. So while they may share a lot of similarities, from that's the point of view, there are still a lot of differences as well. And we're going to try and make those differences appealing and show them how they can benefit you and your clients.
Absolutely.
So just talk a little bit about mutual funds and segregated funds, some of the similarities. The similarities, for those that are not familiar with mutual funds in general, for you who want to go into a bank or make an RSP contribution, if you have $1,000, you want to make a contribution, you want to buy into the market to take advantage of the ups and downs of the markets, $1,000 probably will not get you the proper diversification in your portfolio that you want. So what has happened in the past is that people created these things called mutual funds and segregated funds, that where they take your $1,000 and another person's $1,000 and another person's $1,000, they put them all together into a fund, and that allows you to go out and buy shares or units of a particular mutual fund. And that mutual fund can be anything from a Canadian mutual fund to a US mutual fund, sector specific, like if you want to buy resources or science and technology. So you have a lot more options when you go through mutual funds than buying individual securities on your own. Because
Right.
you don't need as much money to access professional management when it comes to starting a plan.
Right. And just the way I like to explain it, Paul, is it's a mutual fund is like an envelope in which you now have access to a variety of different investments. Instead of you going out there and buying, as you said, the individual securities or the stocks, you can now buy a whole a fund that will be diversified. So you could buy a balanced fund that has a balance of equities, stocks and bonds, different types of investments inside that fund.
Oh, 100%.
Yeah.
Like I said, not only does it give you access to professional management, who's the would be the fund manager and the fund management company, but also allows you, like you said, to diversify your portfolio. If you want a little bit of fixed income or bonds, and you want a little bit of Canadian equity and a little bit of US equity, you can do that with a mutual fund or segregated fund. It makes things very simple. So when you want to buy and sell, you buy into the mutual fund, it does all the work for you. It makes the investments for you. It rebalances the account for you inside the mutual fund. So it's really I'm not going to say quite a set it and forget it solution, but you're paying somebody to make decisions on your behalf who has the experience and the time in the business and the time to do the business, to look at it on a daily basis. It also provides liquidity. So unlike GICs or something like that, where you might be locking in your money, if you need the money, usually it's within your grasp within a couple of days.
Yeah.
So it's 100% liquid, whether it's non-registered or RSP. Obviously, there would be some tax implications if you're going to be taking it out of your RSP, but you can still have access to those funds.
So just to be crystal clear, Paul, when people go to a bank, which is what often people will do when they think of opening an RSP account, or even if people have RSPs through their work, oftentimes what they have access to are what we see on the left side of the slide, which are mutual funds, which you just explained to us. Now, we're now going to talk about how seg funds are different and what additional benefits they present. So seg funds still have all the benefits that mutual funds offer. And in addition to that, they have some additional benefits that you're going to talk about, correct?
Exactly. So yeah, both mutual funds and segregated funds offer you professional management, diversification, simplify process, liquidity, and flexibility. But when you're buying a segregated fund, because it's under an insurance contract governed by the Insurance Act, we're allowed to offer additional benefits.
Nice.
And things like potential creditor protection, tax treatment is a little bit different between mutual funds and segregated funds. Protection features or guarantees, reduced and increased privacy. And I'm going to sort of touch on each one of these in the next few slides to go into a little bit more depth to show how they would actually benefit you in your particular situation.
And I just want to make it clear for people that in order to access the benefits of a segregated funds, you can only buy seg funds through an insurance company. You cannot go to your bank and say, I want to buy a seg fund. So to the extent that the benefits that Paul will be talking about today are appealing to you, or perhaps somebody that you know, you can reach out to me. I'm licensed to offer seg funds, and Paul is part of my support network. So working with a company like Canada Life, Canada Life is definitely one of the providers that we work with, and they're one of the leading providers of seg funds in Canada. So I just want to make that clear that unfortunately, you cannot buy seg funds because they are governed under the Insurance Act. They are under the umbrella of insurance companies. So that's why I just wanted to make that clear. I don't know if you're going to cover that, Paul.
Exactly. This is just sort of a nice one-sentence wrap-up of what the segregated fund policy is. It's an investment portfolio that provides potential growth and flexibility while offering certain insurance protection to the initial investment through built-in guarantees. So when talking about guarantees, this slide looks a little bit complicated, but I'm going to try and simplify it for you. There's basically 3 different guarantees that you're able to have with an insurance segregated fund contract. And the first number is always going to be the maturity guarantee. And the second one is going to be the death benefit guarantee. I'm going to talk mostly about the death benefit guarantee because that's the one where most of the value is. So the maturity guarantee, I'll just touch on saying that if you buy a non-registered policy and you put in $100,000, the maturity guarantee is 15 years out. So if in 15 years from now, if that $100,000 is less than if the market value is less than $100,000, we as an insurance company will guarantee to top up that to $100,000.
Got it.
But the death benefit guarantee is basically when you buy a policy and the amount that you put in is guaranteed, that 100% is guaranteed on death. So if you put $100,000 in today and 10 years from now you pass away, and we unfortunately have hit a place where either earlier this March or back in 2008, that $100,000 is worth $80,000, your beneficiaries actually get the full $100,000 that you put in. So there's very little risk when it comes to on the death benefit side. You're always going to be guaranteed that your beneficiaries will get the 100% premium that you put into the policy.
Yeah, and it's good that you brought up 2008, Paul, because unfortunately we know that when that market happened in 2008 and people saw their equity portfolios dropping down, up to 50%, we know that unfortunately there were heart attacks and there were suicides when people, literally lost their entire lives work, their lifetime savings were decimated in that market. So this is a perfect example where if somebody had been in a segregated fund instead of mutual funds, and unfortunately most people are in mutual funds because they simply don't know what else is out there. They don't know. That's the thing. There's just not enough market awareness about the benefits of segregated funds. But if you had that person who maybe had a 500,000 portfolio that had dropped down to 250,000, let's say they had a heart attack, or they something happened, they couldn't handle it, committed suicide, whatever. Their beneficiaries on the mutual fund side would have only gotten that 250,000, whatever the depressed value of their portfolio would have been after the crash in 2008. If that person had instead been in segregated funds, they would have gotten actually the whole 500,000, the entire protected value of the investment. So it can make a huge difference, especially in times of market uncertainty, the kind of conditions that we actually find ourselves in right now. Because we don't have a crystal ball, but right now we've seen the market go up in value, but that's, I think, all because we're also seeing a lot of money printing, a lot of capital is being injected in the markets right now. But how sustainable is that really? Big question mark, right?
Well, exactly. It's a level of guarantee, and since any time something happens in the market, like 2008 was believe it or not 12 years ago now. So yeah. It's amazing how time goes by.
Yeah.
And people tend to have a recency bias, which means basically they think about probably the last 6 months to a year. So before this past March, the market had been going up and up and up, and people didn't really think about it.
Yeah.
So now we're getting a lot more inquiries about segregated funds because of what happened in March, and the market went down 34% in a very short period of time.
Wow.
And it just makes people think about how can I guarantee, especially older people. Segregated funds traditionally are geared towards people approaching retirement, 55, 60, 65.
That's a question I was going
We're
to ask
also
you.
one of
Yeah.
the few companies that out there that offered 100% death benefit guarantee all the way to age 90. So
Wow.
even if you have yourself, your parents, your grandparents,
Yeah.
if they're looking for options to be able to have some sort of guarantee and still participate in the market, then this segregated funds are usually fantastic for that reason as well.
That's amazing. So just so people get this, you know, in a segregated fund, you could be invested in an equity portfolio or some sort of a balanced portfolio where you can expect to get the upswing of the market. However, you also have this downside protection. So if the market crashes, uh, when it comes to the death benefit guarantee, if God forbid, you know, that person, whether it's, you know, your family member or you yourself, if you decide to put your funds into this type of an investment, your beneficiaries would still get 100% of whatever you put in. So if you put in 100,000, that 100,000 will be guaranteed regardless of what happens to the market. Okay. Now that being said, if the market does continue to go up, you have the opportunity, and I don't know if you're going to speak about this later, Paul, people can reset. So if the market value has gone up every 3 years, Paul?
We have annual resets up to age 70. So
That's amazing. So every year, if the market value has gone up, you can now reset your guarantee. So you reset both your maturity guarantee and your death benefit guarantee, right? Or at the very least, the death benefit guarantee, you can reset it once a year up until age 70.
Exactly.
So it's pretty it's just greater peace of mind in uncertain times, especially when it comes to somebody, you know, if somebody were to pass away, again, their estate is likely to get much higher values in these uncertain times versus if we see another market dip like in 2008, where potentially they may not even have a chance to enjoy the fruits of their savings and investments, but now their estate value is cut in half potentially.
Yeah, and just to make it crystal clear is that they get the higher of the minimum guarantee or the market value. So if that $100,000 is 120,000 or 150,000 when the person dies, then basically that's what they get. They get the market value if it's higher. The guarantee is just the minimum that they're going to receive.
Absolutely. Thank you for making that super clear.
No problem.
Yeah.
So we talked a little bit about the death benefit guarantee. So we talked about $100,000 with no withdrawals, value at death, $90,000. There's going to be a death benefit top up from us at Canada Life of $10,000. So the beneficiary definitely receives $100,000. And that top up is tax neutral. It's not going to be, it's taxed as a capital gain, but it's also written off as well. So it's from a tax point of view, it's going to be tax neutral for the client at the end of the day.
Amazing.
Yeah, no, it's fantastic opportunity.
Yeah, and again, I it's been my experience, Paul, that especially with older individuals, we're being told more often than not, they, as somebody advances in age, they want to be in safe, secure investments. And where I see a lot of seniors putting their money, they go to GICs, right? Well, okay, GICs, sure, you're getting your guaranteed 2%, which doesn't even keep up with inflation, unfortunately. But you're forfeiting any kind of potential growth. Whereas with the seg fund, you could potentially have the market exposure that could increase the value of your investments much more than the 2% guarantee that your GIC is giving you. Okay, and on the downside, if God forbid things don't go so well, if there is a market crash, at the time of your passing, your beneficiaries would still, at the very least, get the, you know, either the value that you invested to begin with or your most recent reset. So if the market kept going up every year, you have the opportunity to reset to the current market value, which would have hopefully gone up by now. So, you know, let's say at year 5 of your holding this investment now, from your 100,000 is now 120. Year 6, things hit rock bottom. There's a huge crash. Well, that's okay. Your family will still get that 125. If something happens to your health, like if you passed away, your family will still get the 125, not the 50,000 that they would have gotten if you were in a mutual fund and there had been a huge decline. I just want to make that super clear, because this is absolutely a unique benefit that only seg funds can offer. There's no other investment in the market that will give you this kind of protection. So especially for people that are at a certain stage in life, retirees, pre-retirees, looking for higher levels of security, including, both for themselves, but also for, if they have a nest egg that maybe they don't even expect to completely exhaust during their lifetime, even more so an opportunity to preserve your wealth. And I know you're going to get into that
Yeah, no,
for your
definitely.
next generation, for the next generation.
Yeah.
Okay.
So
And now
the
you're going
estate
to talk.
bypass works this way. With every contract for a segregated fund, there's three parties. There's an owner, there's the annuitant, who's the basically the life of the policy is based on the annuitant.
Mhm.
And then there's the beneficiary. In most cases, the owner and the annuitant are going to be the same person. So I own my policy, I'm the annuitant, the policy will stop when I die. So when the annuitant dies, that's when the policy ends and the money goes to the beneficiary.
Okay.
So it's like I said, there's different things you can do depending on how, because there's many different structures with families and these days second families and extra kids and so forth.
Yeah.
That we are able to make it flexible with a different owner and annuitant and setting beneficiaries. But it's like I said, 90% of the people are owner and annuitant are the same people, and the beneficiary usually is either spouse or children at that point.
Makes sense.
So we talk about bypassing the state is one of the huge benefits of segregated funds,
Yeah.
especially for non-registered money.
Okay.
So normally what happens is that if you have non-registered money in a mutual fund or individual stocks, here are some of the potential costs that you might incur. So there's always going to be an estate or probate tax. There's going to be estimated probably legal fees of some sort, depending on the size of the portfolio. Executor fees, we'll talk a little bit more about executors in a few slides, but executor fees, a lot of people are maxing those out at the 5% these days, and I'll tell you why once again in a few slides.
Okay.
Accounting fees, surrender fees. So the potential cost can be anywhere from 6.5% all the way up to 21.5% of the overall portfolio.
Wow.
What you're able to do with segregated funds is you're able to bypass the estate and a lot of these costs.
Bypass all that.
Exactly.
Because
So
like a life insurance policy, the money that's in a segregated fund would go to the named beneficiary directly. It doesn't get tied up in the estate, in the probate process, in the whole, it bypasses the whole wrapping up of the estate, so to speak, right?
Yep. So here's a sample here. I like this slide because it tells you a little bit more about some of the costs you may incur. And so you look at the probate costs on $1.5 million, trading or DSC fees. So if you're in a portfolio at with a mutual fund or individual stocks, for them to liquidate that portfolio, it's not like they give you a break on those fees.
That's right.
Whereas with segregated funds, there's no fees on death. If there were deferred service charge fees or there's any sort of fees,
Wow.
those are waived on death.
That's amazing. Okay.
Executor potential fees, legal and accounting fees. So just basically, what do you really want to leave to your beneficiaries? In this scenario with the segregated funds, you're able to leave the full 1.5 million versus almost $300,000 less in fees and costs with regular mutual funds or GICs or individual securities. So it's a pretty powerful slide to really illustrate what a segregated fund can do for you when you're talking about costs and bypassing estate and being able to get the money to your beneficiaries.
Absolutely. Now, I know some of you are watching this and like, $1.5 million, I don't have that kind of money. And I know also that at least some of you in my audience are real estate investors where most of your wealth is held in real estate or some other real estate type vehicles. What we're doing on today's webinar is just letting you know about some of the other stuff that you may not know about. So I hope you will appreciate this because again, I think a lot of people don't know about the benefits of segregated funds, especially when it comes to estate planning and how they could act potentially, again, to help you diversify your holdings, even if most of your wealth is currently held up in real estate, or you may have other types of investments. Like we're going to talk next week about private mortgages, private mortgage lending. I know a lot of you, my real estate investor friends, like those types of investments. again, unfortunately, none of those investments have these types of estate planning benefits that seg funds offer. So I think it's good to at least keep an open mind, see what else is out there, and perhaps some of these solutions may be appropriate for you or perhaps somebody in your family. Just to interlude there, Paul.
That's good. And one of the things I want to talk about is time to receive the funds. Anybody who's actually either been an executor or part of settling an estate realizes that to go through the probate process of going to the courts, making sure everything's in order, getting the paperwork done, paying the costs, that takes time. And the more complex the actual estate is, whether it's due to real estate holdings or multiple accounts spread across different institutions for bank accounts, GICs, mutual funds, stocks. It can take anywhere from probably 6 months to a year or more to settle an estate. And what does that mean? That means that the beneficiaries, especially in the case of spousal, a lot of time, they're not receiving that money right away. How are they going to pay their bills? How are they going to make sure that they've covered the cost for the funeral? With segregated funds and bypassing the estate, those funds are usually in the hands within 2 weeks or less into the beneficiary's hands.
That's amazing.
So it's bypasses the estate, no probate, but really what we're doing is we're supporting the people you leave behind, the beneficiaries, with money in their pockets so that they can take care of their business, continue to live their lives, and cover any costs that were left behind. So it's very, very powerful point of segregated funds versus other investment vehicles is that understanding the value of time and the value of peace of mind as well.
That's amazing. Thanks for making that clear, Paul. Yeah, that's crazy. And I know I had actually, unfortunately, one of my clients passed away not long ago. She had a life insurance policy with me, which paid out. Everything was okay from that perspective. But the husband in this case was, weeks, months later, still dealing with the wrapping up of the estate, dealing with closing bank accounts and doing all of that. And there were multiple beneficiaries involved and just not pleasant. Then when I think about how quickly the life insurance policy settled, and it was a more complicated case because unfortunately the death occurred pretty in the few years following. So there was a little more due diligence following the putting in place of the policy. But in any case, everything worked out. The family was paid, everything was fine. But when I'm thinking that the other aspects of the estate were still being dealt with, whereas if this client had any sort of seg fund investment, it would have gone just like that policy, it would have been settled within, hopefully 2 weeks. I mean, in fact, with a seg fund, it would have been like no questions asked because it's just an investment. It's not a question of whether the client maybe, again, with the life insurance policy, because it was a recent policy, they want to make sure the client didn't lie about anything on the application. But when it comes to a seg fund, it's literally investment. It would have gone straight to the named beneficiaries. And I'm even thinking like those beneficiaries would have possibly have, based on what you're sharing here, they would have had the money in their hands a lot faster as opposed to it being now tied up in this probate process, all the paperwork that comes with that.
Yeah, no, definitely. So we've gone over a couple things so far. We've gone over the guarantees and how they benefit you. We've gone over the bypassing probate, which is fantastic, especially for non-registered accounts. We're going to talk a little bit about potential creditor protection. You mentioned real estate people or real estate investors.
Yeah.
I'm just going to go through this scenario quick. We have a 40-year-old successful real estate lawyer, responsible saver. He's being sued for damages beyond what his insurance company will cover. So if he had mutual funds or individual securities, in this case, he has $75,000 in GICs, $125,000 in registered mutual funds. Ben is required to pay $150,000 in damages over and above what his insurance company is going to cover, right, and therefore must cash in some of his investments, including his recent RSP contributions.
Wow.
So, but with segregated funds, because of the creditor protection, Ben has $75,000 in non-registered funds, $125,000 in segregated funds with his children as named beneficiaries. Although Ben is being ordered by the courts to pay $150,000 in damages, Ben's assets should be protected from the creditors. So his family and himself are still secure, Whereas I can't imagine if somebody came to me and said I had to take $125,000 out of my RSP to pay somebody else for
Wow.
damages.
And Paul, isn't that crazy that I actually thought that RSPs were creditor protected, but I learned from you that that's not the case. They're, if somebody were to go bankrupt, and I know you have another slide on that. Do you mind? Is that your next slide?
I'm just going to walk through one last thing I want to mention about
Sure.
this thing.
Yeah.
Creditor protection is extended if it's a preferred beneficiary's name. So you can't name an aunt or an uncle. It has to be a spouse or children as a beneficiary name to receive the creditor protection.
Okay, thanks for
And
making that
you also can't do things with being sued in mind. So if somebody
right.
is going to be, if you're
That's
a
right.
week away from a lawsuit from doing something illegal, the government comes down pretty hard anyways if they see you moving money to a segregated fund just to avoid being sued.
Or absolutely. So, or once you already suspect that, there's a lawsuit coming and in a hurry, you're going to start transferring funds over from mutual funds or another type of investments to seg funds, that would be seen as being done not in good faith. And that in that case, they may be attacked, right?
That's why we say potential creditor protection, because 9 times out of 10, if you're doing things right, you're going to be protected. But the odd person who doesn't do things properly may get a slap on the wrist and a call from the government.
So I guess the lesson here, Paul, is that anybody who is in a profession such as mine, for example, or either an advisor or a tax, a lawyer,
Doctors,
any kind of
lawyers, dentists,
doctors,
those are high-profile potential lawsuit cases.
So professionals,
manufacturing, if you own
especially
a manufacturing company as well, for potential being sued by one of your employees. So
wow.
we have a lot of clients who are small business owners, who own assets personally and in segregated funds just for that reason, to protect them in case something happens.
Amazing. Yeah. So I want to, again, just make it clear for people what type of person would be ideal for seg funds. So somebody who deals with the public, is in a business where there is the potential of being sued. If you're just an employee, I don't like saying just an employee, but if you're an employee, maybe there's less of a chance of you being sued. But if you're a professional that advises the public or deals with the public, such as a doctor, dentist, lawyer.
If you're incorporated, it's definitely something you might want to take a look at.
Got it. No, thanks again for that. And again, as long as, and again, you want to do them as part of proper planning, not as a last minute, oh my God, I'm going to try to save myself right now because I'm getting sued. No, do it ahead of time, now that you know about the benefits and the fact that, in other words, they would not be able to touch those assets. They cannot go, it's asset protection for people who have something to lose, okay?
Exactly.
Whereas unfortunately, your mutual funds, your mortgage investments are not going to give you that kind of protection. Sorry to tell you, I know many of you like investing in mortgages. And again, there are advantages to that. We're not saying take all your money from one place and put it in another, but just know that no other investment will give you this sort of protection, which is the creditor protection. So.
Yep, and this next slide here just talks about how it varies from province to province. I live in Ontario, you're licensed in Ontario.
Yep.
So is it possible to protect assets in non-insurance registered plans from creditors outside of bankruptcy? And the answer is no. So if you hold mutual funds or individual securities, then the outside of bankruptcy, the parties have the ability to go after those monies. So if it's because of bankruptcy within RSPs, then no, that's not the case. But outside of registered plans, segregated funds is one of the few ways you can protect your assets.
So I understand. So in the case of bankruptcy, your assets, whatever type of assets you have on an RSP, are protected, right? However, if you're being sued in Ontario and you have mutual funds in your RSP, they're not protected. They could go after those.
Exactly.
Correct? That's what this slide is showing. In other provinces, you're protected, but in Ontario in particular, and New Brunswick, and as you can see in Nova Scotia, there are some provinces where you are not protected, and those in particular, and we're not, I'd like to think we're not as sue happy in Canada as our friends down south of the border, because in the U.S. they love to sue for everything, from what I'm seeing. Just driving around. Have you been hurt in an accident? It's a big business there, But in any case, good to know that if your funds were in a seg fund portfolio, they they would be protected again, as long as that investment was done ahead of time in good faith as part of holistic planning. Those
You're good to
creditors
go.
cannot come after you. So, okay.
Exactly.
Oh man.
One of the other benefits, and it's becoming more and more popular, especially with people who have higher net worths. And once again, we talked about varied structured families with second marriages and
Yeah.
stepkids and whatnot. By bypassing the probate, it also brings with segregated funds the ability for privacy. So with any sort of other investment, be it mutual funds or individual securities or GICs, and if it goes through probate, then anybody can go down to the local courthouse, pay their fee, and get access to your will. So here's just a receipt actually from Winnipeg. Somebody paid $5 to get access to somebody's will. And once somebody has access to your will, that really leaves it opened up to challenges from other parties, complaints about family members. And this just sort of probably prolongs the process more and more. Like I said, in this case, it was an estranged spouse was interested in the ex-spouse's inheritance from a grandfather. In this case, like I said, they went down to the courthouse. And you have to sort of ask do your loved ones really want to be exposed like this?
That is crazy. So in other words, if assets are passing through the probate process, which is essentially all other types of assets except for seg funds, except for life insurance policies, which bypass probate and go straight to the named beneficiary. If we're in any other kinds of assets, anybody can go to the courthouse and say, oh, I want to, as a matter of public record, I'm going to pay the $5 or whatever it is, and I want to see what this person's estate consisted of.
Exactly.
That is crazy. That like, now, do they have to prove any kind of family relationship as far as you know, Paul, or can it be literally?
It can be anybody.
Anybody, because it's a matter, once it goes through the probate process.
Once it goes through probate, it's a matter of public record.
Public record. Wow.
So, like I said, privacy is becoming more and more important. As I tell my children, equal is not always fair, or fair is not always equal. So, if you choose to leave a little bit more to one person versus another, or you've helped somebody out over the course of a number of years, one of your children, and you want to make it equal, then you can leave more on death to the other child. So there's a lot of things you can do and can be considered. But making it private is one way to keep the family peace.
Very interesting.
And to make sure your ultimate wishes are going to be observed as well.
Yeah, and I think you have a slide about wills, and last week we had Jack Zwicker as my guest. He's a lawyer, and part of his practice involves wills and powers of attorney. And we spoke about the importance of making a will, because if you don't have a will, you don't have any control as to how your assets get distributed, and in some cases the consequences can be far worse, such as the case as a couple living in a common law relationship, where your intentions may be that your assets go to your common law spouse. In the absence of a will, that's not what happens. And you're leaving people totally unprotected. So, sorry, I keep going in. I know you have some, keep going. I apologize for that. Keep going.
No problem. I'm just going to talk a little bit about estate planning as well. So estate planning is ensuring an individual's personal property is managed effectively during their lifetime, and ensuring an individual's wishes are carried out after their death. So who needs estate planning? Really, everybody does. I'm going to touch on this. I'm sure one of your lawyers in the past presentations has touched on it, but everybody should have a will. It drives me nuts. Like I said, I was an advisor for 8 years. I knew couples with young children with no wills. I knew somebody who had $5 million, no will. It really, really is important to have a will, and I would recommend going to a lawyer to get it done. It doesn't have to be expensive endeavor, but I recommend it for everybody, because what happens if you die without a will is that the Ontario government actually takes over and is able to distribute your assets. And they also, unfortunately, would have a say in if you have young children, if it's not put out somewhere in your will what's going to happen to the children. The government
Yeah.
does have a say on what happens to your children as well after you
Very
die.
scary, guys, especially in these times that we're living in. I really, I can't stress it enough. Please contact Jack. You know, if you don't have, if you have other options, great. But Jack was my guest last week, and we actually spoke about wills and powers of attorney. And he's reasonably priced and lots of experience in this area. He can help get this out of the way, because especially, as you said, Paul, especially in the case of minor children being present, if you don't name a guardian for your children, the government becomes the guardian of your children, okay? And then your family members, whether it's a grandmother or a grandfather or whatever other family member, would have to apply to the courts for guardianship. And they have to prove that they're fit to be the guardian and so on and so forth. So you can avoid all that by having these simple documents drafted. And yeah, so that's all I have to say about that.
So with estate planning, that's just one part of it. It's a very important part, having a will and powers of attorney in place, I think. But everybody should look at estate planning as they get older. Like anybody who wants to create a legacy, conserve assets, distribute their assets in an orderly fashion. That's sort of some of the things we've been talking about by bypassing probate, minimizing their estate processing costs, another important factor. On death of the last spouse, all RSPs are collapsed and brought into the income of the last spouse. So you have to keep that in mind. All capital property is deemed disposed of at fair market value,
Yeah.
Whether sold of or given in your will. So
Yeah.
these things have to be considered as well on your death. So once again, by using segregated funds as part of an estate plan, you're able to distribute your assets a little more effectively in a simple manner and have a lot of cost savings there as well, potentially.
Yeah.
So we talked about estate plans, wills, naming beneficiaries where you can, setting up trusts, potentially using joint accounts where applicable, are some common estate planning tools.
And we're going to have, yeah, then of course, insurance can be a tool in helping provide liquidity to the estate to take care of some of the expected costs on we're talking about real estate, and I've done webinars on this, Paul, and I will, I've done webinars and like presentations to real estate investors groups talking about the cost of owning investment real estate and what happens when an investor passes away and you own investment properties, because it's not as simple as just owning your principal residence. When you own your principal residence, you can pass down to your kids exempt of capital gains tax, which is one of the biggest taxes that we have to deal with. Unfortunately, the same does not happen with investment properties, and the tax burden on the estate can be significant. And a lot of investors have no clue about this. Nobody tells them. It's simply just people just think, oh, I'm worth 11 million. Well, really, how much are you really worth net of taxes? And if I could show you a way to take care of the tax bill and keep your real estate in the family, would you be interested? So.
Yeah. Like I said, from an estate planning point of view, using segregated funds, from a tax point of view, tax planning point of view, through your estate, having insurance in place can be a positive as well. So I'm going to talk a little bit about executors and wills. Like I said, everybody should have a will and have an executor for when they pass on. Not the problem, but the issue these days is that the pressure and the due diligence that executors have to do these days, and the personal liability that they can that could happen to them if something goes wrong when filing is getting more and more onerous. The government has changed the rules. Here's some headlines from Globe and Mail. One is from National Post as well. So now executors must fill out a 7-page information return, and they are looking for a lot of detail. She explained, the Minister of Finance wants to see you include property tax, roll numbers, bank accounts, even vehicles and vessels. You have to get them assessed now to where before they were giving you a best guess on the value. Wow. So becoming an executor and putting the stress on the executors is becoming really, really something that people should be thinking about when they're doing their estate plan. And as I tie this sort of all into using segregated funds, by being able to lighten the load of your executor by using segregated funds to bypass probate, to make sure that the assets get into the proper hands in a timely manner, it not only makes things easier on the beneficiaries, it will ultimately make things easier on the executor as well. And this is where I talked about before, where people are charging more and more as executors, even family members. If you leave your children or whatnot, because this could potentially take a lot of time and there could be some liability on their behalf, they're actually taking money from that from your estate to be the executor and distribute your assets. And once again, this can cause potential disruption in family relationships for those that are left behind. Because if I'm taking 5% as an executor to manage the estate, potentially for years, versus somebody who's doing nothing and they think they should receive more of the estate, or I shouldn't be charging a fee at all. Family harmony does mean a lot to a lot of people when they pass on. So being able to name beneficiaries through segregated funds lightens the burden on the beneficiaries and especially on the executors as well.
Thanks for making that clear. That's, yeah, amazing.
One of the other things that is unique to segregated funds, a lot of people when they pass on, they have different situations with the beneficiaries. Some might have disabled children or children who are not very good with money versus other children who are very good with money and responsible. One of the things you can do through segregated funds is devise a plan after you die on how you want your children to get the money. So at the time of your death, you can, for non-registered policies, you can either provide lump sum monies for the beneficiaries. You can set up a monthly income for life for one or both of your beneficiaries, monthly income for a set period of years, or a combination of all three. So a lot of people are using these as a way to avoid setting up a trust, which can be costly and timely. By being able to set out the parameters that you want your estate distributed to your children, whether it be lump sum or providing some sort of annuity for the child, using segregated funds is a fantastic tool to save money and time once again.
That's amazing, Paul. And you know, this is kind of news to me even as an advisor. Like, I'm aware that I could sell clients an annuity based on today's date. And we're going to have you back to talk about the annuities, because that's another topic that I think a lot of people, they would have heard of it, but I have no idea what are annuities, how can they be helpful, and so on. But you're saying that upon somebody's passing, could an annuity be set up upon somebody's passing?
Exactly.
In perpetuity, now in the name of the beneficiary.
Exactly. So they can, if they have a disabled child that they want to get $1,000 a month for, they can arrange that when they set up the policy, saying X amount of dollars on death would go into an annuity to fund that annuity for that disabled child.
That is fascinating. So you literally can use seg funds and annuities, which are kind of a sister product to seg funds, also offered by insurance companies,
Yep.
To literally plan things way into the future. You literally can get your wishes made the reality beyond even the time of your passing, to make sure that you're not, for example, leaving a large sum of money to a beneficiary that may not be able to handle it, you know, because they're 25 years old and they're, you know, in their party mode or what have you, you know.
Some people are good with money, some people are not. So it doesn't necessarily mean something against that child or that person, but being able to make sure that they have an income for the rest of their life, or at least to supplement another income for the rest of their life, is can be invaluable to somebody, like as a parent anyways.
Absolutely. Absolutely. No, hey, I'm grateful my parents are still alive and well. Never mind. But I mean, if you're as a parent, and again, we're talking about this type of planning, I think definitely will appeal to baby boomers, people who are at that stage of life where they are starting to think about, hey, what happens when I'm no longer here? What would I want to have happen? And you know, that's when this type of planning can really be helpful, and make sure that whatever you leave behind, you're leaving your kids, your beneficiaries, in truly a better situation. And that you're not, because again, to leave a large lump sum of money to somebody who cannot handle that could actually be more of a curse than a blessing. Because what are you really teaching them? And also, you haven't worked hard all your life, so that somebody who is not good with money will potentially squander that wealth. So yeah, I absolutely love the flexibility and just the possibilities that um, that seg funds can make possible. And again, I don't think there's any other type of plan out there. When I did my will, for example, yes, I said, oh, I want a certain amount of my whatever is left of my estate to go to my son at a certain age and so on at a certain age. But then it would be up to the executor to somehow ensure that that happens. So again, more burden on the executor to now, okay, well, you're only going to get this much as age 18, this much as age 25, whereas this could have actually been for somebody who has this type of planning done, a seg fund plus an annuity, it could literally be done at the time of setting up the contract. So you're, again, less burden on the executor to try to set that up when you're not even here anymore.
Yeah. And because we are able to offer 100% death benefit all the way up to age 90, we see a lot of money coming in from GICs sitting at the bank where they would be subject to a lot of taxation
Telling one of my
and
neighbors.
flexibility. So we see a lot of money coming over for the sole purpose of passing it on to the next generation. They're never going to touch this money, but they want to make sure that it's going to the right person in the right way in a timely manner. So we've seen a lot of money coming into our segregated funds for that reason alone.
That's amazing. You're opening my mind up to the possibilities, Paul, and I definitely think, at least some of my clients and some of my audience would be curious to learn more about what some of the possibilities are, because again, most people, and again, people of a certain age, it's been my experience, they just want to be super safe, so they put all their money in GICs and then they forfeit any market growth, and on top of that, okay, fully subject to taxation, fully probatable, so tied up. So if their intention is for this money to go to their kids or grandkids, yeah, whatever is left of it will eventually get there once probate has had its way with it, whereas they have the opportunity, if they know they're not going to touch this money in their lifetime. And again, I have one of my neighbors, but it's just, I think, a matter of opening people's minds up to the possibilities, because and we're having this issue with other types of investments as well. People have a lot of trust in the banks, and they almost think that anything other than the bank is not safe somehow, even though a company like Canada Life, it has been around since 1876. I think that's what you told me. So insurance companies, guys, life insurance companies like Canada Life have been around since, some of them before the banks, okay? So, and these types of products have been on the books. Like, I know whole life policies, Canada Life has been offering whole life policies for the past 150 years. There are insurance products and insurance companies that have been around longer than the banks, or at least as long as some of the banks, and that offer greater levels of guarantees and greater benefits that you're not going to get at the bank. So my thinking is, keep an open mind. And so those of you who are watching today's webinar hopefully are keeping an open mind and are open to learning about what else is out there beyond what you can get at the bank. So that's all I had to say about that.
Okay. I'm sort of going to finish on a couple of things here. One is, no matter what you do when it comes to investing, there's going to be a cost to investing. And where segregated funds and mutual funds are very similar in many ways, it is a fact that segregated funds, there are additional costs. And those costs are usually wrapped up with the additional benefits that you're receiving as well, though. So to have the guarantees in place, the creditor protection, the estate bypass, those all are come at a cost, unfortunately. So this slide just illustrates the difference between mutual funds and segregated funds. We've taken an aggregate of some 246 mutual funds and 142 segregated funds, and we've plotted out the difference in cost. So fixed income fund on the mutual fund side is 161 MER, or we'll call it cost right now, versus 2.14 for segregated funds. And balanced funds 2.44 versus 2.68. So there is a difference in cost. However, price is only an issue in the absence of value.
Absolutely.
So if you see value in what segregated funds can offer for you or your parents or your grandparents, then the additional costs will be not really applicable or not really noticed. I've illustrated that with one of our balanced funds here. This is a TD Greystone balanced fund. So over the years, and all these returns, these are the annual compound return for the portfolio. So these returns are always net of fees. So this is the return after fees have been taken out. So if you look sort of, obviously it's a wide variety of returns over the years as the markets go up and down.
Yeah, it's a balanced fund, yeah. So you can expect some, a balanced fund would have about usually 60% in equities or something, upwards of 50% in equities usually.
Exactly.
So of course there's going to be a component of that is subject to market fluctuations. And but what were you you're just gonna show us, this is I see. So the returns you're getting would be very comparable to what you'd get with a mutual fund.
Exactly. With a balanced mutual fund, like since inception, this has got about 5%. And for a balanced fund, that's usually what I quote a client saying what your expectations could be between 4 and 5% with a balanced fund in this interest rate environment.
Got it.
So, and that's net of fees. That's plus all the, that's the plus guarantees, plus creditor protection, plus like you're getting all of that. Yeah. It does come at a cost, but at the end of the day, you want to make sure that what you're invested in is going to get you to where you need to be from a financial plan point of view. And put it into a balanced fund and get 5% return. I know I'd be happy with that for a balanced fund over a 10-year plus 10, 15-year period, 5% a year. That's not too bad. Obviously, if you want to take more risk on, we have other funds that offer more equity.
Sure.
But
sector funds, I mean, we know, I've seen some of the seg funds that we have access to. Some of the sector funds, there's precious metals or real estate or
science and technology fund, which has done 17% a year over the last 10 years.
Exactly. So some of these sector funds can offer really impressive returns, but at the same time, yes, they can be a lot more volatile as well. So the recommendation is you don't want to put more than just a small percentage of your portfolio in some of these sector funds. You don't want to put all your money in that. And then again, when clients see, 20% return, amazing. Okay, well, just be aware that it could go the other way as well.
Exactly.
So, but again, I think that and I believe this is your last slide, or do you have more slides, Paul?
No, this will be my last slide. So.
Okay, that's right. Yeah, so I think the conclusion is you get what you pay for. So even though the cost of investing in a seg fund as opposed to mutual funds, or as opposed to, earlier in my webinar series, I had somebody from a robo-advisor company come and talk to us about investing in ETFs, okay? We're talking about two different types of investments, because on the one hand, yes, you only care about the fees and your returns, but you're not getting any of these benefits that we just talked about. So I think for perhaps somebody in their 20s, maybe ETFs and mutual funds may be okay. The older we get in life and the closer to the event, that's where people are looking for higher levels of protection and guarantees, and the whole estate planning conversation becomes more and more important. Making sure that more of your wealth can actually flow easily to your loved ones, as opposed to it being tied up in the probate process and being subjected to all these fees and taxes. So they're literally like different, opposite ends of the spectrum, and there's room in the marketplace for everything, and depending on the client's age and their priorities. I wanted to have you on so that people are at least educated about the world of seg funds, because again, for many people out there, they may not even have heard of seg funds, and even if they've heard it, it's a buzzword. They have no idea. And even as advisors, yes, we learn about them. I've had some exposure, and I've definitely helped some of my clients with them, but I never really oversold these benefits. I literally offer them as an alternative to a mutual fund. But you know what? I'm actually very happy now, more than ever, to be reminded of some of the estate planning benefits, because these are great for clients. These, especially clients of a certain age. Again, there's no other type of investment that will give this sort of benefits, other than insurance policies, which also can go straight to the beneficiary and bypass probate. and are tax-free in addition to that. But we'll talk about insurance policies on other calls. So everyone, Paul, as mentioned, is one of our value partners. He's with Canada Life, and Canada Life has a great array of seg funds, balanced funds, sector funds, you name it. Depending on your risk profile, your risk tolerance, we would look at what would make sense for you if this is something that you wanted to explore. I would be your first point of contact. I usually have my contacts light up, but I didn't get it up, Paul. So I'm just going to say, if you wish to get in touch with me, I can be reached at info@mavenwealth.ca. And again, I work with someone like Paul. Paul would even be willing to join us on a Zoom call. Everything can be done virtually right now. If you're currently in a mutual funds portfolio or in a GAC somewhere at a bank or other financial institution, and you're thinking, I like what I heard on today's call. This is something that I can see integrating as part of my planning. Don't be shy. Feel free to reach out to me. Again, I'm at info@mavenwealth.ca, M-A-V-E-N, wealth.ca, or you can reach out to me on Facebook as well. And we can definitely set up a call and see if this could indeed be something that could be of value to you. And Paul is definitely there, one phone call away, one email away, to also bring his expertise, his insights to us. So with that said, Paul, thank you, by the way, for the presentation. Thanks for bringing your expertise to today's call.
Oh, you're welcome. Thank you for having me.
My pleasure. So I'm going to go back on Facebook now, Paul, and see if there were any questions from our audience, okay?
Okay.
Let you know. No, we just have a couple of likes on there. And so thanks everyone for watching. I really appreciate it. Thanks. And if you do have any questions, feel free to put them in the comment section or send me an email. And myself and Paul would be happy to answer them. Okay. Thanks again, everyone. Have a great rest of the week. And thanks again, Paul.
No problem. Thank you.
My pleasure. Okay. And I think you may have to end. Oh, no, you made me back the host. Okay. Wonderful. Okay. We'll be in touch, Paul. Thanks so much.
Take care. Thank you. Bye-bye.